Hey everyone, welcome back for another deep dive.
Always a pleasure.
Today we're going to be talking about something that honestly I think affects every single one of us.
Absolutely.
Emotions and how they impact investing.
Yeah, we like to pretend like when we make investment decisions, we're being completely rational.
Right.
We look at the numbers, we do our due diligence. But the truth is, our emotions play a much bigger role than we might realize.
Yeah, and I feel like I've definitely fallen into those traps before where I'm like, oh, this is, I'm feeling really good about this, or I'm letting maybe fear get the best of me.
It happens to the best of us.
Yeah. So how do we even begin to untangle that knot?
So there's a field called behavioral finance.
Yeah.
Which is really fascinating, and it dives into this whole idea that we're not always rational actors when it comes to money.
So not just about spreadsheets and algorithms.
Not just spreadsheets and algorithms. There's a whole human element.
There's a human side to it.
Absolutely.
Okay, so let's talk about how these emotions actually come into play.
So imagine you've got two systems going on in your brain.
Okay.
One is very fast, intuitive, emotional. That's what we call system one.
Okay.
The other one, system two, is much slower, deliberate, analytical.
So system one is like, buy.
Yeah, like a gut reaction.
Okay, got it.
And system two, like, hold on a second, let's think this through.
Let's do some research. Let's look at the...
Exactly.
Okay.
And ideally, those two systems work together, but sometimes, particularly when it comes to investing that system one, it can kind of hijack our decision making.
Oh, totally. I've been there.
And we end up making choices that we later regret.
So let's talk about some specific examples, because I think a lot of us have those stories.
Oh, we all do.
Of like, oh, why did I do that?
Yeah, for sure.
So what are some of the big ways these emotions can kind of lead us down the wrong path?
Well, you mentioned getting caught up in the hype.
Right.
So that's a classic example of something called overconfidence bias, where we kind of overestimate our abilities or our knowledge and we downplay risks.
Ooh, yeah. I remember buying this one tech stock and I was like, this is it. This is going to be the next big thing.
There you go.
And it was not.
And that's exactly how this bias can play out. We get so excited about the potential upside that we completely overlook the downsides.
We think we're invincible.
A little bit, yeah. We think we've got it all figured out. And this can actually, on a larger scale, contribute to things like market bubbles.
Oh, wow. So
remember the dot-com bubble?
Oh, yeah, vaguely.
Vaguely, yeah. So, there was real innovation happening.
Right.
But it was that overconfidence that really fueled those unsustainable price increases.
Okay, so that's a big one, overconfidence. So what else should we watch out for?
So another big one is loss aversion.
Loss aversion.
Yeah. So this is the idea that we feel the pain of a loss much more intensely than we feel the pleasure of an equivalent gain.
So like losing $100 hurts way more.
Way more.
Than the joy of gaining $100.
Exactly. And this can really mess with our investment decisions.
How so?
Well, think about it. We might hold on to losing investments for way too long.
Oh, yeah.
Hoping they'll bounce back.
Been there.
Even when it might make more sense to just cut our losses.
It's like you get so fixated on getting back to even that.
Yeah.
Yeah. And you don't want to sell because you don't want to take the loss.
Exactly.
So interesting. And speaking of getting fixated.
Oh, yeah, there's another one.
There's another one. I bet there's more.
Called anchoring bias.
Anchoring. Okay, what's that?
So this is where we latch on to a specific piece of information.
Okay.
And we let it distort our judgment, even if that information's not really relevant anymore.
Okay, so give me an example of how this plays out with investing.
Sure. So let's say you buy a stock at $50 a share.
Okay.
You might get anchored to that price.
Okay.
And even if the company's fundamentals change or the market conditions change, you might hold on to that stock.
Waiting for it to go back to 50.
Waiting for it to go back to 50.
Even if it's like a completely different...
Even if it's a completely different situation.
Oh my gosh.
Yeah. So that initial price becomes this mental roadblock.
Wow. That's a good way to put it, a mental roadblock.
Yeah.
So we've talked about overconfidence, loss aversion, and anchoring.
Yeah.
Those are three big ones.
Three big ones.
I'm sure there's more.
Oh, there are plenty more, but those are some of the most common ones.
Okay, so these are all kind of happening on an individual level.
Yeah.
But do these play out on a larger scale too?
Absolutely. So all these individual biases can actually manifest
in
the market as a whole.
So give me an example.
Well, think about herd behavior.
Okay.
That's a classic example.
So that's that idea that we just follow the crowd.
Follow the crowd, even if it goes against our own better judgment.
Oh yeah, FOMO, fear of missing out.
Big time.
You see everyone buying something, you're like, I got to get in on that.
Exactly. And this can lead to those market bubbles.
Oh wow, okay.
Driving prices up way beyond what's reasonable.
So it's like this collective overconfidence?
Overconfidence, yeah. Or even fear on the other side, where everyone starts selling at the same time.
It creates a huge wave.
Huge waves.
Okay.
So you can see how these individual emotions, they can really impact the market as a whole.
Wow.
Yeah.
So I think we're starting to see how these individual biases, they can really add up and affect
absolutely
the whole system.
Whole system.
Okay, so we've covered those two systems of thinking.
Right.
We've talked about overconfidence, loss, aversion, anchoring herd behavior.
Yeah.
It's a lot to take in.
It is.
It is, but it's so fascinating.
It is fascinating.
And I think just having that awareness is so important.
Absolutely. Awareness is the first step.
So where do we go from here? How do we actually use this knowledge to make better decisions?
Well, that's the $1 million question, and that's exactly what we're going to dig into in the next part of our deep dive.
Okay, so stick with us as we continue to unpack this topic.
Yeah.
And explore some practical strategies for navigating this complex world of emotions and investing.
Sounds good.
Okay, so we've established that emotions can really kind of mess with our heads when it comes to investing.
Sure.
But how do we combat those biases and make more rational choices?
Well, the good news is that just being aware of them is a huge first step. Yeah. Like even just acknowledging that, hey, I'm susceptible to overconfidence or loss aversion. Okay. That in itself can help us start to catch ourselves when those emotions are starting to drive our decisions.
So it's kind of like hitting the pause button before we make that impulsive trade and saying, wait a minute.
Exactly.
Am I really thinking this through, or I'm just caught up in the moment?
You got it.
So having that self-awareness is key.
It's huge.
What else can we do to kind of keep those emotions in check?
You know what can really help is having an investment plan.
A plan.
A plan.
Okay.
Like a roadmap. Okay. So you're not just wandering around aimlessly.
So we don't get lost in the emotional wilderness.
Yeah, exactly. A plan can help you stay focused on those long-term goals and avoid making those impulsive decisions based on, short-term market movements.
Right, because that can be really tempting.
Oh, big time.
Just to react to what's happening right now.
Yeah, and the market's always going to be going up and down.
Right.
But if you've got that plan, you can kind of weather those storms a little bit better.
Okay, so awareness, a plan.
Yep.
Anything else we can do?
You know what else can be helpful?
Yeah.
Get an outside perspective.
Okay.
Talk to a financial advisor, a trusted friend, someone who can offer a more objective viewpoint.
So it's like having that sounding board to kind of bounce ideas off of and make sure we're not, just going off the rails.
Yeah, someone to kind of call you out for being a little bit too emotional.
Exactly.
Yeah.
Okay, that's a great tip. What else?
You know what else?
Yeah.
Don't underestimate the power of focusing on the long term.
Oh, okay.
So much of the stress and the anxiety that we feel when it comes to investing comes from getting caught up in those day-to-day fluctuations, right? But if you can kind of zoom out and look at the bigger picture, those short-term swings become much less emotionally charged.
Because we're not just looking at the trees, we're looking at the whole forest.
Exactly. And remember, investing, it's a marathon, not a sprint.
That's a good one.
And you know what? If you do make an emotionally driven decision,
which we all do.
We all do.
It's going to happen.
It's going to happen.
It's okay.
It's okay. Just try to learn from it.
Learn from it.
And do better next time.
So it's not about trying to be like these perfectly rational, unemotional beings.
Robots, right? We're human.
We're human. We're going to have emotions.
Yeah.
It's about learning to manage them. And they don't completely control our decision.
Okay. I like that I'm feeling better already. But let's get even more practical here.
Sorry?
Can you walk me through a couple scenarios?
And how we might apply some of these strategies.
Yeah, let's do it.
Okay.
So imagine you're facing a market downturn.
Ooh, okay.
Fear is in the air. Everyone's panicking and selling.
Yeah.
What's your first instinct?
My first instinct, honestly, is to sell everything before it all goes to zero.
I think that's a pretty natural reaction.
Right.
But remember, market downturns, they're a normal part of the cycle.
Okay.
So instead of panicking, this is where that investment plan comes in.
Okay.
Take a deep breath, review your plan, and assess the situation rationally.
So not letting fear drive those decisions.
Exactly. Ask yourself, has anything fundamentally changed
okay.
about the companies that I've invested in? Or is this just a temporary dip?
Okay, so it might actually be an opportunity.
Could be.
To buy more.
Potentially.
At a lower price.
If your investment thesis is still sound,
okay,
a downturn can actually be a good thing.
Wow, okay. I'm going to have to work on that mindset shift.
It's a big one.
Yeah.
But it's important.
Okay, so let's flip the script. The market's soaring.
Okay.
Everyone's making money left and right.
Yeah.
You're seeing all these hot stocks popping up on your social media feed.
The fear of missing out. Oh, the FOMO is strong.
Big time.
What do we do?
Again, hit that pause button.
Okay, pause.
Before you jump on the bandwagon,
okay,
ask yourself, is this investment actually aligned with my goals and my risk tolerance?
Okay.
Have I done my research?
Right.
Or am I just letting the hype dictate my decisions?
It's easy to get swept up in all that.
It is. It's very tempting.
Yeah.
But remember, hype can be dangerous.
Okay.
Just because a stock is going up doesn't mean it's going to keep going up.
Right, right.
So separate the noise from the facts and make those decisions based on sound reasoning, not just the excitement of the moment.
So it sounds like whether the market's up or down, it really comes back to having those strategies to kind of stay grounded, stick to the plan.
Absolutely.
Not let our emotions run the show.
It's all about that emotional regulation. Okay, what about some of the ways that emotions can kind of sneak in that we might not even realize?
Oh, there are plenty.
Yeah.
Plenty of sneaky ways.
Like what?
Well, we talked about home country bias before.
Right, that idea that we tend to favor companies from our own country.
Exactly.
Okay.
Even if it might not be the best investment decision.
So how do we combat that?
Well, awareness is the first step.
Okay.
Recognize that this bias exists, and then make a conscious effort to broaden your horizons.
Okay.
Consider diversifying geographically.
So not letting familiarity kind of limit our potential.
Exactly. Sure. And here's another interesting one. Our emotions can actually influence how we perceive risk.
Oh, really?
Yeah.
Okay.
So someone who's generally risk averse might become more risk tolerant.
Okay.
When they're feeling optimistic.
So our perception of risk can change.
It can fluctuate.
Depending on our mood.
Depending on our mood, exactly.
Wow, that's fascinating and a little scary.
It can be. Yeah. So if we're feeling overly optimistic, we might underestimate the risks involved.
Right.
And conversely, if we're feeling fearful or anxious, we might overestimate the risks and miss out on great opportunities.
It's like our emotions are creating this distorted lens through which we're viewing everything.
That's a great way to put it.
So again, it's about understanding our own emotional patterns.
Yes.
And how they might be impacting our decisions.
Exactly.
All right. So we've talked a lot about how our emotions can kind of sneak into our investing decisions and how we can start to manage those emotional responses.
Yeah, it's a lot to process.
But is there even more to this?
There is.
Like how our brains actually work.
It's funny because even our thought processes themselves can contribute to those biases that we've been talking about.
So are you talking about like those two systems of thinking again?
Exactly. System 1 and system 2.
Okay.
That fast intuitive thinking versus the slower, more deliberate thinking.
Right. System 1 is like the buy.
Yeah, like that gut reaction.
Yeah. And system 2 is like, hold on a second. Let's pump the brakes.
Yeah, let's do a little more research.
Exactly. So how do those two systems play into all this?
Well, the thing is, we tend to rely on system 1 a lot more than we realize.
Really?
Especially when we're dealing with complex topics like investing.
So even when we think we're being rational, our emotions might still be influencing us.
It's very possible. Our brains are wired to look for simple explanations and patterns.
Right.
Even if those patterns aren't really there.
I guess it makes sense. It takes a lot of energy to really think things through.
Exactly. Our brains love those mental shortcuts. Yeah. And this can be made even worse by the way information is presented to us.
Okay, so like the news.
Exactly. Yeah. The financial news loves to focus on the dramatic stuff.
Right.
Big winners and losers.
They gotta get those clicks.
Exactly. And that can really trigger those emotional responses.
Makes sense.
And make it even harder for us to think clearly and objectively.
So it's not just what's happening in our own minds, it's also like the outside world.
Absolutely, it's all connected.
And speaking of the outside world, what about the role of like social dynamics?
Oh, huge.
Like how does that play into investing?
We're social creatures by nature.
Right.
We're constantly being influenced by the people around us. And that can lead to herd behavior.
Right. That's where we just follow the crowd.
Exactly, even when it might not be the best idea.
And that FOMO, fear of missing out, is so real.
Oh, yeah. Especially with social media these days.
Yeah. You see everyone talking about a stock.
Yeah. And you feel like you're going to miss out.
I got to get in on that.
Exactly. But it's important to remember that just because everyone else is doing something doesn't mean it's right for you.
Right.
You got to do your own research.
Think for ourselves.
Exactly. And there's another layer to this too. Social norms and expectations.
Oh, interesting. Okay.
You know, we might feel pressure to invest in certain things because that's what our friends are doing or our family's doing.
So it's not just about following the crowd. It's like meeting those expectations.
Exactly. And that can be really tough to resist.
Yeah. So it's this combination of our own internal biases and those external pressures.
Exactly. And you know what adds another layer of complexity?
What's that?
Culture.
Culture.
Different cultures have different attitudes towards things like risk time horizons and even the concept of money itself.
So someone's background could really influence how they approach investing.
Absolutely. Some cultures might be more risk averse. Others might be more comfortable taking on big risks.
So fascinating how it's not just about like the numbers and the data. It's
about the human element.
Yeah.
It's about psychology.
So knowing all this, how can we actually use these insights to become better investors?
Okay, so the first step is just recognizing that we're all susceptible to these biases.
Okay, so self-awareness.
Self-awareness is key.
Once we admit that, hey, I'm not perfect.
Exactly. We all have these biases, and they can sneak into our thinking even when we don't realize it.
So how do we start to identify those biases?
We'll start paying attention to your emotional responses
Okay.
when you're making investment decisions.
So like if I'm feeling really excited about a stock, maybe that's a red flag.
Yeah, exactly. Ask yourself, why am I feeling this way?
Okay.
Is this rational, or am I getting caught up in the hype?
So take a step back and really analyze those feelings.
Exactly.
Yeah. Okay, what else?
Another powerful strategy is diversification.
Oh, diversification, classic advice.
It's a classic for a reason.
Right?
Don't put all your eggs in one basket.
Especially if we're feeling emotional about a particular investment.
Exactly. Spread that risk around.
Okay.
And here's another key one. Focus on the long term.
Okay.
Market fluctuations are going to happen.
Right. Ups and downs are normal.
They're part of the game.
So don't let those short-term swings derail your whole plan.
Exactly. Stay focused on your goals.
Stay the course.
And finally, don't be afraid to seek professional guidance. A financial advisor can provide that objective perspective.
Yeah, someone who's not caught up in our own emotions.
Exactly. That can help you develop a sound investment plan.
And keep us grounded.
And keep you grounded when those emotions start to run high.
That's a great tip.
So remember, investing. It's a journey. It's not a destination.
It's a marathon.
It's a marathon. And there will be ups and downs along the way.
Absolutely.
The key is to stay focused, manage your emotions, and make those decisions that are right for you.
This has been such an incredible conversation.
It's been fun.
I feel like I've learned so much.
I'm glad to hear that.
About how our brains work and how these biases can really affect us.
It's fascinating stuff.
So to our listener out there, thank you so much for joining us on this deep dive.
Yes, thanks for listening.
Into the world of emotions and investing.
We hope you learned something.
Remember, stay curious. Keep learning.
Yes, and keep those emotions in check.
That's a great reminder. And until next time, happy investing.